Stocks are off to a slow start to begin this new trading week. Let's get perspective on it now from Scott Wren. He's Senior Global Equity Strategist at Wells Fargo. All right, Scott, this is why they pay you the big bucks. So the storyline seems to be that stocks are down because we've seen a sell-off in the bond market. Now, I think people would think, oh, if you're selling bonds, maybe you're buying stocks, maybe feel good about an economic recovery story. And the bond market does seem to be factoring in an economic recovery on the way. Why do these dynamics impact the price of equities?
Well, John, I think part of it, or probably a really big part of it, is because we've had such a run higher here, over the course of the last 9 months. So we're at some elevated levels. We've gotten to these levels pretty quick. We know that early in an economic cycle, higher interest rates, higher inflation, that's a sign of a good thing, as you mentioned. I mean, the bond market is telling me, at least, that we're expecting some better economic activity. Along with that, some inflation. I mean, you're seeing things like the price of copper and other industrial metals go up. So for us, that's a positive sign. And while we think that inflation is going to go up, CPI maybe a little bit over 2% this year, we're not worried about just a big surge in inflation that then continues. So for us, I think the market's kind of looking for excuses right now, and in the last few days, it's been the inflation scare excuse. But for us, at least at this point, we don't see meaningful inflation developing. We see good inflation, and we think it's good that interest rates are moving a little higher.
Okay, so given that is your view, what has been your advice to investors? How are you positioning the portfolio for 2021?
Well, we've continued to lean toward risk assets that are going to benefit from a continuation of the recovery, not just here in the States, but abroad as well. We've gotten more interested in materials. We've gotten more interested in industrials. We've got an overweight rating on financials. We still continue to like technology, consumer discretionary, those sectors too. So what we've tried to do incrementally, and this is really post-pandemic, we've tried to incrementally add risk as we've had our feeling about the future has improved. We've continued to do that. We've continued to encourage our clients to buy and put some of that sideline cash to work when we have the opportunities, which, let's face it, in 2020, we had a lot of opportunities. We think we'll probably have a few more here. Inflation scare, that always takes a little bit of air out of the market. So we'll be looking at this as an opportunity, and we'll be continuing to lean towards those sectors, those asset classes that are going to respond well to a continuation of the recovery.
Scott, Amber was making the point earlier, when you're at this stage in a recovery, people start to take a closer look at some of the value plays. Maybe those names that have stretched valuations get less of a look. Already today, we've highlighted some weakness in technology stocks. It's been hard for investors to bet against big tech just because at the end of the day, they're the one group you can rely on that has steady Eddie money that's flowing in all the time. How do you feel about the dynamics of big tech right now and investing in that sector as we're starting to talk about an economic recovery?
Well, John, Amber was exactly right. Technology growth stocks, let's face it, in the pandemic, they've been able to, still knock the cover off the ball and make a lot of money. That's one of the reasons why we've tried to stick with them. And that's one of the reasons why probably in this particular cycle, we're going to see value do fine early here, which we've certainly seen that in the last few months. That's one of the reasons why we like financials. But I think that in this particular cycle, what you're going to see is that value is going to do better, but probably not to the magnitude that it has in previous cycles. It was more cut and dry back then. I think there's still going to be some uncertainty here, but we've got a 4.7% GDP estimate out there. I think if we're wrong, it's probably going to be greater than that. So you want to, once again, you go back to those plays that are going to respond positively from a bounce back in economic activity. And really, if we had to guess out into 2022 right now, and that's all it would be a guess, is you could easily see growth again north of 3%. So when you see 2 years in a row of pretty good economic growth, you don't want to be hiding in utilities and staples and things like that. You want to be looking to add some risk. Valuations, let's face it, stocks aren't cheap. But I think in these easy money times, there's a lot of pent up demand. There hasn't been much chasing at all in this market, maybe by some retail traders, but not by just retail investors. So I think the breadth of the market, the lack of chasing, where the Fed is, all of those things suggest to us that we're not at the top in terms of valuations, and we think stocks have some upside here. Certainly, if you throw in a couple of percent for dividends, let's call it 7 to 9% from here through the end of the year.
All right, and before I let you go, Scott, I want to dive into one sector in particular. Christina Hooper of Invesco was with us earlier talking about consumer discretionary being a category that benefits from a recovery. And that includes a whole bunch of different stocks. I mean, it can include, names like Starbucks, for example, but it can also include the airlines. And already this morning I was alluding to the fact that there was a Deutsche Bank analyst who put a buy rating on every U.S. airline on the general themes around vaccination. It's kind of interesting because on the one hand, we've been leading with this story around Boeing's woes. But generally speaking, we're really seeing some optimism on the heels of that analyst commentary today in some of the U.S. airlines. Still seems like there's a lot of uncertainty in getting back to normal. How do you feel about arguably the riskier parts of that consumer discretionary sector, the groups that really rely on us feeling safe, feeling vaccinated, ready to go in a big way?
Well, I think, that's an example. Airlines are one of those. And, the thing is, John, those are such a small portion of the market cap of the consumer discretionary sector. What we try to do, and this is with any sector, not just that, you want to try to figure out what are the drivers. And, right now you've got, if you take a look at internet retail, if you take a look at auto retail, if you take a look at the sub industry, the home improvement retail, I mean, that's where all the cap is. And so these other things, whether it's apparel or leisure or airlines, those are just rounding errors in what the consumer discretionary sector is going to do. So we do expect a bounce back because we think the unemployment rate is going to go down. People are going to have money to spend. They're going to go out and spend it. But, those things, particularly airlines that you mentioned, those sub-industry groups are not going to be the drivers in the consumer discretionary sector. You have to look to those, 2, 3, 4 really big cap companies that have driven it so far. And if those companies don't continue to outperform, consumer discretionary is not going to continue to outperform.
Interesting. Yeah, names like Disney have been on a tear recently. Hey, Scott, thanks very much. Always good to get your perspective. Much appreciated.